This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Okay, we're going to look at question 4 of the June 2010 Paper F9 exam. So as always, let's spend a few minutes just looking at the requirements, as I would do in the 15-minute reading time, and then we'll start working through it. So look at the requirements, ignore the body of the question for the moment. A. Calculate dividend yield, capital gain and total shareholder return for 2008-2009. So even though we've not looked at the numbers yet, that's fairly conventional. That should be easy enough. However, the reason there are 10 marks is it says briefly discuss your findings with respect to 1. The returns predicted by capital asset, and 2. Other financial information. So there's quite a lot of written there. There won't be that many marks just for the numbers in the first line. B. Calculate and comment on the share price using dividend growth model. Well, dividend growth model, you should be aware that there is a formula on the formula sheet, so there's an easy mark there for knowing what formulas you use. We're asked to calculate it, so hopefully that's going to be easy enough, sticking figures in the formula, but we're also asked to comment on it. So again, a few marks for yet more written. Finally, C, 8 marks. Discuss the relationship between investment decisions, dividend decisions, financing decisions. Illustrate with examples where appropriate. 8 marks there. Again, writing. There's a lot of written in this question. At least half the marks, more than half the marks out of those 25 are for writing. But part C, again, is fairly standard. We'll discuss it obviously when we come to it. But you should be able to get reasonable marks on part C. However, let's start working through part A. First of all, let's do the numbers. Calculate dividend yield, capital gain, shareholder return. And you can see above we've got various bits of information for each of 3 years. So, dividend yield first of all. I think it's worth writing down what it is. It always give you a mark even if the numbers have gone wrong. But the dividend yield is simply the dividend per share as a percentage of the market value. So what do we get? 2008, the dividend per share, 38.5 cents. Market value, generally here you would use the opening market value, so the value at the end of the previous year, 2007, which was 740 cents. So the dividend yield, 5.2%. And similarly in 2009, dividend 40 cents, opening market value 835 cents. Is what, 4.8%? Now we're not asked to comment at this stage, so let's just get the numbers out, but there's the dividend yields. The capital gains, so the change in market value, 2008, the market value ended at 835, it had started the year at 740. So a gain of 95 cents. You can, if you want, express this as a percentage, but there's no particular need. But there's a gain of 95 cents per share. 2009, it ended at 648. It had started at 835. And so here there's a capital loss. It's negative of $1.87 per share. Finally, the overall shareholder return, the total, what do you call it? Total shareholder return. is effectively the two together. So in 2008, we got a dividend of 38.5 cents. In addition, there was a capital gain of 95 cents. So there is the total return, expressed as a percentage, again, of the opening market value of 740 cents. So I get an overall return of 18%, 18.04. And finally, for the numbers, 2009, the dividend 40. Here a capital loss of 187 cents on an opening market value of 835. And so the overall return, it's negative. I get 17.6%. So I think there is pretty easy marks for the numbers. What about the discussion, though? Number one, discuss them with respect to returns predicted by capital asset pricing model. So in 2008, we actually got 18%. Capital asset pricing model said 12. So the actual results were higher. Whereas in 2009, capital asset had said, predicted 8%. We obviously, it was negative. We were less than capital asset. Now, why are we different? In a perfect world, capital asset should determine the returns we get, so to speak. Share price changes accordingly. Well, really two main things to say. One is, it could be that it's not a perfect market. No perfect knowledge, because capital asset does rely on shareholders having full information about what's happening. A second thing, though, worth mentioning is betas are capital asset deals with the business risk. It's measured by the beta. We normally look at it for the sector on the assumption that all similar businesses have similar risk. Well, it would seem to suggest here that our shareholders perceive the risk of the company to be different from that of the sector. We don't know here, but maybe in 2008, for whatever reason, they felt our business was less risky than that of similar companies. In 2009, more risky. That also could be a factor. What about two? Other financial information. Well, of course, if you look back at the information he gave us, all right, we've used dividend information, we used share price, but there was more information given, so mention it. An easy mark is turnover. In 2008, there was growth. Not massive, you don't really need the figure, but it grew by 0.2 million on 6.6 million. It grew by 3%. I say you didn't actually need the figure, but it had grown a little in 2008. But of course, in 2009, there is zero growth. And clearly that is a bad sign. If turnover's falling, the company can't maintain growth in dividends. What about earnings per share? Again, there been growth in 2008. Again, you don't actually need the figure, but what was the growth? 64.2 as against 61.7. I think the growth is about 4%. But it fell in 2009. And again, a bad sign. What about the dividend? Now, I know we've worked out dividend yield, but in absolute terms, the dividend per share has continued to grow. We had growth in 2008 and in 2009. Again, I will put figures. It grew by, in 2008, it grew by 1.5 cents on 37 cents. 4%. Roughly the same as earnings. In 2009, it grew again by 1.5 cents on 38.5. Slightly under 4%. Now that's worthy of comment that despite fall in turnover and earnings, the company has maintained dividend growth. Now that's a fairly common policy. Companies, to keep shareholders happy, they like to have consistent growth in dividend, and that's fine for the short term. The big problem, of course, is that they cannot maintain dividend growth in the future unless they turn the company around, unless they start getting growth. In turnover and earnings. There's clearly a problem here. Something needs doing. If they don't do anything, if turnover stays static or starts to fall, then they can't continue to grow the dividend. And that's the big worry. One other thing you could have calculated, he didn't ask for it specifically, but the information's there. Something he often does ask for, it's important, the PE ratio. The PE ratio is the market value per share divided by the earnings per share. Well, in 2008, and we tend to use closing market values for this, so 835 market value, earnings per share 64.2. At 13 times, whereas in 2009, market value 648, earnings 58.9. Sorry, 648 divided by 58.9. It fell to 11 times. Now, you should be aware the P ratio is an indicator of expected growth, and the fact that it's fallen, the fall in 2009, suggests that shareholders are expecting lower growth in the future, which, given what we've already said, is hardly surprising. Anyway, that's part A. Let's move on to part B. Calculate and comment on the share price using the dividend growth model. Well, immediately, you should remember that on the formula sheet is a formula, the dividend growth formula for market value, that the market value, the share price, P0 is D0 1 plus G over RE minus G. Now, obviously, we'll put numbers to it, but write that down. It's going to get you a mark, even if you have problems with the arithmetic. Anyway, they want us to do it based in the following circumstances. One, based on historical information. Now, it does say something about dividends for the future, but if we're talking about historical information, what do we know? Well, D0 is the current dividend. We're at 2009, so the current dividend is 40 cents. The required return, RE, the same as the cost of equity, which we're told is 10%. G is the growth rate. And the growth rate, if we're using historical information, we know what the dividends have been this year, last year, the year before. So the average growth rate, remember, I'll have a mini lecture here. The earliest dividend was 37. If it's growing on average at G per year, then after 2 years, by 2009, multiply by 1 plus G each year. So 2007 was 37. Add on 2 years' growth, and by 2009, it's actually grown to 40. And so the average, 1 plus G squared, is 40 over 37, or 1 plus G is the square root of that. Well, the square root of 40 over 37 is 1.03, about 1.04. And so G, the average growth rate, is 0.04 or 4% per annum. So we've got D0 and RE, we know the growth rate, so now we can use the information. P0, D0 1 plus G over RE minus G. D0 was 40 cents. The growth rate, 0.04. RE, the required return, 0.1. The growth rate, 0.04. And what does it come to? I get 6.93 cents, or $6.93. It does say calculate and comment, so before we do the second bit, let's comment on that. That's what the dividend growth model says, but of course the actual share price is $6.48. What does that suggest? It'd be, in theory, it'd be $6.93 on the assumption that growth would continue at 4%. Well, the fact that it's lower, that suggests shareholders are expecting future dividend growth to be lower, which is hardly a surprise. To be lower than in the past. I was saying that's hardly a surprise from everything we've already said. That does make sense. What about number 2? Again, they want us to use the dividend growth model, but if the proposed change in dividend policy is implemented, and what's the proposed change? Below that little table, one of the items discussed at a recent board meeting was the dividend payment for 2010. The finance director proposed that in order to conserve cash within the company, no dividend would be paid in 2010, 11 and 12. It would be expected that improved economic conditions at the end of the period would make it possible to pay a dividend of 70 cents in 2013. And we then expect an annual increase of 3% could be maintained. Now, they want us to use the dividend growth model, but the first thing to be very clear about is this, that the dividend growth model, when we did it in part 1, we were working out a share price at 2009. We used the formula D naught 1 plus G over RE minus G. Well, D naught was the current dividend, the 2009 dividend. But if we multiply by 1 plus G, it's assuming that the dividends are going to grow at G per year. And so this bit was the dividend, the expected dividend, in 2010. It's 2009's dividend, D naught, times 1 plus G, well, the dividend in 2010. Now, we're going to use the same formula, but what we know is that the dividend in 2013 is 70 cents. We have no choice but to assume the cost of equity stays at 10%. We're told the growth rate's going to be 3%. But before I do the arithmetic, what's that going to give us? If we use the dividend in 2010, it would have given us a market value in 2009. We've used a dividend in 2013. It'll give us a market value in 2012. 2010 went back to a value in 2009. 13 goes back to value in 12. Or if you prefer, we're using the dividend 3 years later. It'll give us a share price 3 years later. Well, before I go any further, what does that come to? That comes to 1,000 cents, remember. However, we want the market value now. The market value at 2009, whereas 1,000 is what the market value would be in 2012. Well, effectively, we're using the fact that the share price is the present value of future dividends. But to go back from 2012 to 2009, we're going to have to discount 3 years. So it's 1,000 times the 3-year discount factor at the shareholders' required return the cost of equity, 10%. And the 3-year discount factor, 10%, is 0.751. Now learn from that, because for different reasons that exercise has been necessary more than once in the exam. It's pointless me repeating, and if you need, wind back the recording and go through it slowly. But we're using the dividend growth model. But because everything's 3 years further on, we've had to discount 3 years to get, if you like, today's share price. He wanted us to calculate and comment. Well, again, how does that fit in with the actual share price? The actual share price is $6.48. Why is it lower? Well, of course, it's because shareholders don't have the information. In theory, if shareholders knew what was going to happen, and obviously believed it, then the share price would have gone to $7.51. However, given that this information presumably isn't public, it's only proposed anyway, they base it on their current expectations. So that's the reason it's lower. The actual price is lower. Because the proposed suggestion is not publicly available information. Okay, nearly there. That was part B. Let's go on to part C. And part C is very much independent. However easy or hard you found A and B. Discuss the relationship between investment decisions, dividend decisions, and financing decisions in the context of financial management. Well, they're very much interrelated, and in fact, dividend and financing are almost what you might call the same decision. But the point is this: the investment decision that one on its own, we're talking here about investing in new projects, new machines, etc. Well, clearly we should look for projects with positive net present values. However, where's the money going to come from in order to invest and expand the company? One place it can come from is from dividends. You can finance from retained earnings, and the amount of retained earnings depends on the dividend policy. And the company really has two choices. They either pay a high dividend, but if they pay a high dividend, there's no earnings left for reinvestment. And so you'll expect low growth. Or alternatively, You can pay a low dividend, high retention, in which case there's more retained for reinvestment. And of course, if every year the company's investing more, you'll expect more earnings, so there'll be expected growth in earnings and therefore dividends. Now that's what we talk about by dividend policy. Shall we pay a high dividend? Shall we pay a low dividend? In theory, it makes no difference. In theory, shareholders won't care whether they get a high dividend but low growth, or a much lower dividend but high growth in the future. In theory, it makes no difference, and in fact, that's Modigliani and Miller. It's one of the things they said. However, in practice, dividend policy can have an effect. It can have a signalling effect. What that means, if a company pays a low dividend, shareholders worry that company's doing badly. So even though they may be paying a low dividend in order to get high growth in the future, which is not bad, if shareholders worry that the company's doing badly, it causes problems. The other danger is what we call the clientele effect. What this means is we might be attracting shareholders who want high dividends, maybe pension funds, for example. Well, again, it's no good saying to them, we're paying a low dividend, but don't worry, you'll get growth. If they want the cash, they're going to have a problem. So that's what we need to say about dividend policy. The other thing, though, if we're going to invest in new projects, well, one way is dividends, but the other way, of course, is to raise new finance. And this is what's referred to by the financing decision. And without going into all the possible sources, which isn't required here, it's only 8 marks, remember, essentially the financing decision is, if we're going to invest, do we raise debt or raise equity? Now, of course, it's Modigliani and Miller. According to Modigliani and Miller, it makes no difference. According to Modigliani and Miller, the value of the company will be the same whatever happens. The value of the company stays the same. And as I said, again, it is Modigliani and Miller who came to that conclusion. And so just as we've said, in theory, the dividend decision is irrelevant, equally in theory, the financing decision is irrelevant, but in practice, it does make a difference. First, Modigliani and Miller assumed a perfect market. They made lots of assumptions, but they did assume a perfect market, no issue costs, and perfect knowledge. And, of course, the effect of tax, that debt borrowing gets tax relief on the interest. Equity doesn't. And that makes debt borrowing more attractive. So, there we are. In theory, it's only the investment decision that matters. As long as we invest in good projects, it's fine. Positive net present values. But in practice, both the dividend policy and the financing, or the dividend decision and the financing decision, in practice, they do have an effect. And companies do have to consider what's the dividend policy going to be, and are we going to raise debt or are we going to raise equity?